You can be driving 100 miles an hour down the highway, making all the right career moves and pulling in a massive salary. But if you don't know exactly where you are going, speed won't help you. Earning a high income does not automatically generate structural wealth. Take a look at this bar chart. It visualizes data from a recent Goldman Sachs survey, and the numbers are alarming. Even at the highest income brackets, 40% of people earning over $500,000 a year report living paycheck to paycheck. The math here reveals a glaring dilemma. Most high achievers are incredibly good at the offensive game, grinding for promotions and building businesses and scaling their income, but they completely ignore the defensive game of wealth retention. This line chart illustrates exactly what happens. Your earning trajectory climbs steadily, but your actual wealth retention flattens out. That widening red gap is what we call the defensive drag. Taxes, lifestyle inflation, and lazy debt management act as a parachute on your money's velocity. The good news is that we don't need to rely on guilt trips or scolding to fix this. We can calculate the cold, hard return on investment of plugging those leaks. As your net worth scales, the exact traits that helped you build wealth, your relentless hustle, your towering ego, and willingness to take risks, become the exact mechanisms that will destroy it if you don't optimize them. Let's start with the first set of traps, administrative leaks. Fixing these requires high mental friction. Nobody likes doing paperwork, but they offer massive, mathematically guaranteed financial returns. Your largest single expense in life is almost certainly going to be your tax liability. Yet it is incredibly common for high earners to leave money on the table by holding their investments in the wrong types of accounts. The input required here is simple but tedious. It means spending a few hours at the end of the year strategically selling positions to harvest tax losses and making sure your high dividend stocks are sitting inside a tax-sheltered account like a Roth IRA. The trade-off is that you have to confront boring paperwork and delay immediate access to some of your capital. The outcome is a drastic reduction in your lifetime tax bill. Every dollar saved here stays in your portfolio to compound. The second major administrative leak works the exact same way, and that is being lazy about debt refinancing, specifically with your mortgage. Take a standard $400,000 mortgage dropping from 7% to 6%. You save $263 a month. But with a $10,000 refinancing fee, it takes exactly 38 months to break even. Stay 5 years, it's profitable. Move soon, you lose money. Overcoming the laziness of administrative friction is the highest, most predictable return on your time available. Now we enter the second quadrant, ego traps. These are the exact opposite of administrative leaks. The paperwork is incredibly easy, but the emotional suppression required is high. The most dangerous trap here is over-concentration. Consider Intel back in 2000, a darling tech stock that peaked at $65 a share. Even with recent runs, those early investors never broke even. A 2 or 3 year hot streak in a bull market doesn't make someone a genius stock picker. Often, it just makes them dangerously overconfident. The necessary input is forcibly diversifying that winning portfolio. Most professional wealth managers insist that no single stock should exceed 5 to 10% of your total holdings. You are trading the lottery ticket upside and the ego boost of telling your friends about your massive wins at dinner parties. In exchange, you secure the objective, systematic compounding of a broad index like the S&P 500. That ego check becomes even more critical as your net worth grows. Suddenly, your assets start getting complicated. You might dabble in angel investing, private equity, or real estate partnerships. This creates a psychological trap. High earners often pretend to fully grasp these complex investment vehicles just to save face. When you are faking comprehension, you inevitably miss hidden fees and miscalculate your structural risk. The fix is swallowing your pride. When your financial structure outgrows your DIY capabilities, you need to pay the upfront fee to hire a fiduciary financial advisor. True wealth preservation means prioritizing the boring reality of risk mitigation over the thrill of high-stakes bets. Our final quadrant covers lifestyle and time. This is arguably the hardest category to correct because it is tied directly to your personal identity and societal signaling. As soon as your income increases, the temptation to show off that new money through visible consumption kicks in. This is the classic mechanism of lifestyle creep. The absolute best mathematical defense is to commit to a strict rule. Save exactly 50% of every future raise or promotion you receive. You trade immediate gratification and visible status symbols for rapid, liquid accumulation. You keep your living expenses modest, while your actual net worth quietly skyrockets behind the scenes. But there is a final, insidious trap that catches almost every high achiever. They become so focused on growing their money that they forget their time is ultimately more valuable than their labor. This scale diagram demonstrates the transition. If you build a $5 million portfolio and it earns a conservative 5% return, your money is generating $250,000 a year. That is $684 a day in completely passive growth. Capital starts to outpace labor. Stepping off the professional gas pedal requires a massive mental shift. You have to actively unlink your personal identity from your daily hustle and audit how many hours you are actually working. Money loses its entire utility if it does not eventually buy back your time and autonomy. This decision matrix maps out exactly what you need to do next based on your current wealth stage. Identifying where you are right now tells you exactly which leaks to plug first. If you are the high-income earner, meaning you have a large salary but low liquid assets, your highest return on investment is purely behavioral. You need to fix lifestyle creep and automate 50% of your future raises. If you are the emerging accumulator, holding between $100,000 and $500,000, your highest ROI is structural defense. Divest your concentrated stock picks into index funds and optimize your tax shelters. If you are the successful grinder with a net worth over $1 million, your primary task is auditing your blind spots. Hire a fiduciary to catch complex risks, verify your liability insurance limits, and start capping your labor hours. Earning money requires massive talent and forward momentum, but keeping that money is a quiet, unglamorous administrative choice. Make the choice to defend your wealth, and you will actually get to enjoy it.